Hello, this is Ijaz Khan, and in this video, we are going to discuss overtrading. What is overtrading? Overtrading is basically a situation where a company is trying to expand its operations, that is, sales and purchases, without sufficient backing of capital. Let's try to understand with the help of an example. Let's say you open up a small pizza shop with only one delivery vehicle. And in order to increase your sales, you may offer deals that will stimulate demand and increase your sales orders. And let's go further and let's assume that you also offer sales on credit so that you are able to increase your sales further. Since you've put on this promotion and you have also offered credit, so you expect more customers order coming up. Therefore, you will be buying more inventory, and since you will have limited capital available as you're a small pizza shop, you'll probably go for credit purchases and hence will increase your current liabilities. Or probably you may also go for overdraft to finance your other expenditures as well. So you will now start receiving orders, and they may be in numbers, but with limited production capacity and with limited delivery vehicles, there is a great chance that your customer orders may be delayed and you may have angry customers. And this is going to affect your goodwill. At the same time, since you have bought your material on credit, or you may have also obtained overdrafts, so there's a great chance that you may not be able to meet your current liabilities on time as you will be relying too much on your current liabilities. So you will also have angry creditors. And if these things get worse further, this may lead to bankruptcy and you may have to close the business. So, is it good to have overtrading? Should any company be overtrading? Of course not. If this is what is the probable end of overtrading, then of course it's not good for any business to be overtrading. Now, is it always apparent to know whether the company is overtrading or not? No. The company may be overtrading, but at the same time, it will not have any idea of whether it's overtrading or not. So it's very important that the company traces or identifies whether it's overtrading or not so that it can overcome its overtrading if it is involved in. So, how do we come to know about a company whether it is overtrading or not? There probably will be reasons that will help us find out whether a company is overtrading or not. One of the symptoms will be a significant increase in its revenue without sufficient increase in its non-current assets. So if a company is increasing its turnover but is not increasing its non-current assets or investment in non-current assets, then it is one of the signs of overtrading. Along with the first sign, there will be falling profit margins, because the company will be offering discounts in order to increase its sales, and that will be reducing its profit margins. The reliance on the current liabilities will be increased, and it will also lead to an increase in bank overdraft. The payable days will increase because the company will have difficulty in paying its debts on time. And on the same day, in the anticipation of increasing more sales, it may be offering generous credit terms and it will be increasing its receivable days. The current ratio will probably increase because of increase in inventory and receivables. The inventory turnover will be low as to increase its sales. The company will be buying more and more inventory and will be piling more inventory in anticipation of getting more orders. This will eventually increase the inventory turnover. And there will also be an increase in asset turnover, that is the ratio of sales to capital employed. It will also increase because the sales will be increasing, but the capital employed may not increase in the same proportion. So if majority of these symptoms are present in any company's situation, it will be called as over trading. So if in the exams you get a question on identifying whether a company is overtrading or not, it will relatively be a very simple question. You will have a financial performance of the company in the form of its income statement and balance sheet. It it will have a comparative financial statements from one year to another, and all you have to do is to find out the increase in the sales revenue, the net profit margins, the gross profit margins of both years, the percentage increase in the overdrafts, the payable days, receivable days, inventory days, current ratio, quick ratio, and asset turnover ratios. And just compare with these symptoms and see if these symptoms are present. And in case majority of these symptoms are there, you can reach to a conclusion that the company is over trading. Now, definitely when a company is over trading and it is identified that the company is over trading, then we should be looking for how to deal with the over trading, how to reduce this over trading. So the heading here shows it's the symptoms of overtrading, but it's no more symptoms. Now we're talking about the remedies of overtrading. So one of the ways to handle the overtrading situation will be to renegotiate with the customers and also renegotiate with the suppliers. With the suppliers, slow down the growth of trading volume, and that will probably be done by reducing discounts offered, and it will reduce the sales growth, reduce the stock levels, stop buying, and try to utilize the current stock as quickly as possible. And also try to arrange for the long-term source of finance, either issue shares or go for long-term debts that so that you have a capacity to invest in your long-term assets. So for practice, go for a Gorva company. It's a December 2008 exam question of financial management paper. It's the best question for practicing this over trading topic. Thank you for watching.